When the Great Depression came, it became clear that the economy could implode and that you had to do something about it. The notion of aggregate demand became very central, and again, that was new at the time. And given that the economy was not self-stabilizing, there was a need for very aggressive policies. And at the time, there was probably more of a focus on fiscal than on monetary policy, but the notion that fiscal policy was essential as a stabilization device. Then came the stagflation of the 1970s. The notion was that given that we were seeing both stagnation and inflation, the Keynesian way of thinking about things, which was of a trade-off, was wrong. I mean, the word business cycles, which had more or less disappeared, reappeared as the notion that, yeah, there are ups and downs and you have to handle them, but basically the economy is largely stable, and what you need is very simple rules, clear rules, to make sure that people understand what policy is about, and everything will be fine. With that, there was a shift towards away from fiscal, towards monetary policy, and then we got the great financial crisis. And so the question is, well, now that we've seen it, now that we've gone through it, what is it that we should conclude? The first one is the absolutely obvious one, which is the centrality of the financial system. The second one may be, from a conceptual point of view, the most important one, which is the nature of fluctuations. I think the notion that the economy is self-stabilizing is clearly a major question. Then the third one is not really a lesson from the crisis, but it is a lesson about the environment, that for the foreseeable future, we're going to be operating in a very different environment from the previous one, an environment of very low rates, and very low rates have major implications for the behavior of the financial system and for the behavior of the economy. So it interacts with the first two. You know, the question is, why did we ignore the financial system so much in mainstream macro? And looking around, going outside of the Anglo-Saxon world, we should have known. So we know much more, but it's the usual line. We know much more, but we still know much less than what we really need to know in order to control the beast next time that there is a problem. And here you could think of a number of issues on which I think we still don't have a good control. During the crash, the relative roles of solvency and liquidity. Clearly, you need some worry about solvency to get a liquidity crisis, but you need very little to get it going. And what is the relation between the two, and what was the state of the various financial institutions? The other is, after the crash, you basically have low capital in various places. Some people believe that the big issue is to put capital in the banks. Some people believe that instead it's helping households basically get out of the hole and not deleverage too much. We had converged to a view that had fluctuations as a result of shocks, many shocks all the time, and then propagation mechanisms. So consumers would become a bit more pessimistic. This would have an effect for multipliers, and eventually they would go away. The point is that I think financial crises just do not fit that vision of fluctuations in various ways. The first one is the notion of shocks. I mean, financial crises are big shocks when they happen, but they started long before. It's not as if there is a large shock. It's basically that there's a build-up and a build-up and a build-up, and then suddenly it crashes. If you look at the last 6 recessions, the average decrease in the policy rate was 5%. Now, it's very clear that there is not that kind of margin at this point. Hope that next year nothing bad happens, and we don't expect in expected value, it's likely. But you know, what about the recessions 3 years down the line? What can we do between now and then to basically put in place a system in which we have more margin, which I think is the way we should think about this. The simplest way of doing it is just to have higher inflation. And if you have inflation at 4%, you probably have rates at 6%, and then you should be okay most of the time. But you know, the pros and cons are well understood. The second challenge is the relation of central banks to financial stability. Should it be part of a mandate? Should they be active? Should they use monetary policy as opposed to macro-prudential policies to deal with what looks like asset bubbles or credit booms? Our conclusion is no. monetary policy should be involved in financial stability, but it should not use the usual tools of monetary policy. It should basically do macro pro with other players who clearly have to be involved. What should central banks go back to? And here, I think we make two basic points. The first one is that that's not a well-defined question. That basically we should be thinking about the consolidated debt of the central bank and the government. And the result is, what is the debt which is in the hands of the public? And basically both of them have an effect on it, and that needs to be coordinated at the minimum. Because of the constraints on monetary policy, you better have something else. If a recession comes, you probably want to be able to use fiscal policy. The other is that you clearly have much more room to use it without getting into trouble because the interest rate is so low relative to the growth rate. So if you think about the events of the last 10 years, and they are quite incredible in retrospect. There was runs on the largest financial institutions. Interest rates have been in a liquidity trap for 10 years in some countries, nearly 10 years in others. There are still very large unemployment gaps in Europe, which I think are partly due to cyclical factors, not entirely structural. Output is still far below the pre-crisis trends. So things have happened. And I think in the light of this, returning to something like business as usual would be just wrong. I think what we have learned is economies do not self-stabilize by themselves. You actually have to do something. They may implode, and they would probably have imploded had the reaction been different in 2008, 2009. There may be hysteresis, there might be long-run effects of recessions. And so what is needed, I think that's a main message, you need very aggressive, proactive and reactive demand policies. Not only demand, but surely demand is important. And that's why we've called the paper Back to the Future, which is we basically, I think, have a message which is not very different from the one which came after the Great Depression.
The textbook orthodoxy with respect to demand policy for the last 25 years has consisted of three propositions. One, do not screw up the long run by yielding to the temptation to do things that are attractive in the short run that will end up only creating inflation in the long run. Two, do not become a source of instability by moving erratically and unpredictably. Three, as long as you're not doing one of those two things, lean into the wind and make fluctuations less volatile. It's my view that that orthodoxy is likely highly inappropriate for the next 2 decades, and I think Olivier's view that it is flawed and not entirely adequate to the next 2 decades. There is substantial reason to believe that rather than excessive demand, the produced by temptation, yielding to temptation, the larger problem for the industrial world over the next 2 decades will be insufficient demand produced endogenously by the economy by a variety of forces that lead to a chronic excess of saving over investment. And that's what the secular stagnation idea refers to.